If you've spent any time looking into leverage trading, derivatives, futures, that sort of thing, you've likely run into a word that feels less like a tool and more like a warning sign.
Leverage.
Exactly. Leverage, it's intimidating, it's full of jargon, and it really comes across as this inherently reckless thing designed to just wipe out your account.
It absolutely does. And the common narrative is that the higher the multiplier, the higher the risk.
Yeah.
And that's true on the surface because leverage certainly amplifies your outcomes.
Right. Amplifies everything.
But our mission today, diving into the sources you sent over, is to really cut through that emotional noise
Yeah.
and just establish the mathematical reality of risk control.
Okay, let's unpack that right away because we are dealing with what seems like a central paradox. Leverage lets you control this huge position with very little capital. But the true dollar risk, the actual money you lose when a trade goes south, is not defined by that 10x or 50x multiplier. It's defined by two completely different things.
Precisely. Our goal here is to shift your focus from that flashy multiplier to the dull but crucial math. It's about understanding how to calculate your exact position size to manage your predetermined risk budget, down to the cent.
So let's start with the absolute basics. What is leverage if we strip away all the fear?
At its core, leverage is simply a facility. It allows you to use a small amount of capital, what we call margin, to control a much larger notional position size.
Okay.
So if you have, say, $1,000, and the exchange offers you 10x leverage, you can control a $10,000 notional position. That's the engine for magnified profits,
Right.
but also magnified losses.
And this is where the big misconception lives, isn't it? The narrative is that the 10x, the 20x multiplier itself is the source of all the danger.
Yes, and while it's true that high leverage can deplete your collateral faster if your positions are way too big, the real risk isn't the multiplier.
So what is it?
The critical distinction is this. Risk is ultimately a function of your position size and your stop distance, not the leverage multiplier you happen to choose. You could use 5x leverage and take on insane risk, or you could use 50x and be taking on minimal risk if your position is tiny.
Let's use that source example because this is what makes the light bulb go on for a lot of people.
Let's do it.
Okay, so imagine you have a $10,000 trading account and you've set a strict rule for yourself. You will risk no more than $200. That's 2% on any single trade.
A very sensible rule. Now, let's say your analysis tells you that you want to control a $5,000 notional position.
Right. So if I open that $5,000 trade using a low leverage setting, maybe 5x, how much margin do I need?
You'd need to post $1,000 as your initial margin.
And what if I use a much higher setting, say 20x?
Then you would only need $250 of your own capital as margin.
Okay, that's a massive difference in the collateral I have to lock up. But here's the real question. In both of those trades, if the asset moves 4% against me, how much money do I actually lose?
You lose exactly $200 in both scenarios.
The same amount.
Exactly the same. The notional size of $5,000 is the constant. That's what determines your dollar loss. The leverage just dictates how little of your capital you need to post to open the trade.
That's fascinating. It suggests that high leverage is really just a capital efficiency tool.
That's the perfect way to put it.
It frees up your capital from being stuck in margin so you can use it somewhere else, as long as you keep your position size correct.
That's exactly right. If the outcome, the dollar loss, is identical, regardless of the multiplier, then the multiplier is clearly not your main tool for risk control. Position sizing is.
Okay, so that brings us to the formal definition of true dollar risk. This feels like the foundational starting point for any smart trader. What's the general rule of thumb?
The starting point is always defining your risk per trade, the absolute maximum capital you are willing to lose. And the overwhelming recommendation from pretty much all sources is to risk no more than 1 to 2% per trade of your total account.
So on that $10,000 account, 1% is a max loss of $100.
Right. This protects your longevity. It ensures that even a horrible string of 10 straight losses only costs you 10% of your capital, not everything.
So we have our dollar budget, say $100, but how do we translate that into the actual number of units or contracts to buy? This is that mathematical bridge where so many beginners get lost.
And that bridge is built on your stop distance.
Okay.
The stop distance is that critical price gap between where you enter and where your stop loss is set. It's the amount of negative movement you're willing to accept before the trade is automatically closed. It dictates everything.
So if my dollar risk is fixed at $100 and my stop distance is fixed, then that has to dictate my position size, right? If I widen my stop, I have to take a smaller position to keep the dollar loss the same.
Absolutely. The tighter your stop, the larger the position you can take on while staying inside your $100 budget. That dynamic is the whole game.
All right, let's lay out the core position sizing formula. It's deceptively simple once you see the parts.
It is. The formula is position size in units equals your account risk in dollars divided by your trade risk.
Okay, so the top part, the numerator, is easy. That's my $100 maximum loss. But let's clarify the denominator, the trade risk. That's the stop distance, right? Like the entry price minus the stop price.
Exactly. And we should make it really concrete. Let's use that simple example again. We have a $10,000 account. We're risking 1%, so $100.
Okay.
And let's say the asset we're trading is at exactly $1, and we set our stop loss at 99.5 cents. So 0.995.
So the stop distance is $1 minus 0.995. That's a half a cent difference, or 0.5%.
Correct. Now we just plug it in. We take our account risk, $100, and divide it by the trade risk, which is that half a cent, or 0.005.
So 100 divided by 0.005 gives you 20,000.
A $20,000 position size, or 20,000 units.
And that is your mathematically required notional position. If you buy 20,000 units at $1 and the price drops to your stop at 99.5 cents, you lose exactly $100. Your risk budget is perfectly honored.
But if you just ignored the math and bought, say, 40,000 units instead, that same 0.5% price move would cost you $200. You've just blown your risk budget no matter what leverage you used.
That's the core takeaway then. Position sizing is the primary control.
It is.
So if the math is the front-end control, what's the back-end safety system? That's where margin and liquidation come in, right? This is where the exchanges themselves enforce the rules.
Yes, and we need some clear definitions here because the jargon can get thick. We know notional position size, that's the full value you control. Then we have margin, which is just the collateral you post. Think of it like a security deposit.
And there are two key types of margin.
Exactly. You have your initial margin, which is what you need just to open the position. Then there's the really critical one, maintenance margin. This is the absolute minimum equity you have to maintain to keep that position open.
And if your losses cause your equity to dip below that maintenance level, that's when you hear the scary word, liquidation.
It is a feared word, but it's really just an automated safety feature from the exchange. When your equity crosses that threshold, the exchange forces the position closed.
Why?
To prevent you from losing more money than you have in your account. It stops you from going into negative equity and owing the exchange money. It's their risk control as much as yours.
But this brings up that really frustrating scenario you hear about all the time. Had a stop loss set, but I still got liquidated. That usually comes down to the difference between last price and mark price.
Yes. This is a super important nuanced point. The last price is simply the most recent transaction price on that specific exchange. Your stop loss orders are usually triggered by the last price.
But the liquidation system doesn't use the last price. Why not?
Because the last price on a single exchange can get crazy volatile. Imagine a flash crash on just one platform. To avoid liquidating people unfairly, the exchange needs a more stable reference. So they use the mark price.
And what is the mark price?
It's a calculated fair value. It's usually an index price, derived from a basket of price data from multiple major exchanges.
So if there's a weird sudden price spike down on my exchange, the mark price, which is looking at other exchanges too, is less effective.
Precisely. The mark price is used specifically to calculate your unrealized profit and loss, and most importantly, to trigger liquidations. It's a protection against faulty local data. The catch, though, is you can get liquidated if that mark price hits your liquidation trigger before your stop loss, which is waiting for the last price, can get filled.
That makes perfect sense. The mark price is the exchange saying, we're using the global temperature gauge, not just the thermometer on your front porch.
That's a great way to put it. Now, we should pivot to the specific dangers of high leverage, because while the multiplier doesn't set your dollar risk, it definitely reduces your margin for error.
Okay, so with high leverage, we're talking about a much thinner margin buffer. What does that mean in practice?
It means the gap between your equity and the required maintenance margin becomes incredibly narrow. Your liquidation proximity is just extremely close to your entry price. The buffer is much less forgiving. A tiny sudden twitch in the mark price can wipe out all the margin for that trade.
In other words, the higher the leverage, the less the price has to move against you to trigger a total loss of your margin. You have no breathing room.
And that thin buffer is threatened by more than just price. There are other hidden costs that eat away at it. The first one is slippage.
Right, slippage. We hear about this a lot during big news events.
Slippage happens when your stop loss gets triggered, but because of high volatility or low liquidity, your order actually gets filled at a worse price than you intended.
So you budget for a $100 loss, but the trade actually closes with a $120 loss.
Exactly. Your perfect math is suddenly broken by market reality.
And there's a second hidden cost, something unique to perpetual futures.
That would be the funding rate. These are periodic fees, usually paid every 8 hours, that go directly between long and short traders. They exist to keep the futures price pegged to the actual spot price.
And these fees come directly out of your margin, right?
They do. So if you're holding a position with very high leverage, your margin buffer is already paper thin. These funding fees, which can get quite high sometimes, just eat away at that buffer, potentially pushing you into liquidation, even if the price barely moves.
So high leverage becomes very expensive to hold over time.
It absolutely can be.
For our more experienced listeners, let's quickly touch on the two main margin systems, isolated and cross margin, because your choice there is a big deal for overall risk.
Yes. Isolated margin is the default, and it's generally safer for speculation. It restricts the risk of one trade to only the margin you allocated to it. If that position gets liquidated, the rest of your account is totally safe.
It's like a firewall between your trades.
A perfect analogy. It creates isolated risk buckets. On the other hand, you have cross margin, which shares your entire account balance across all your open positions. It's more capital efficient, especially for something like hedging.
But the danger with cross margin is that if one position starts to go really bad, the exchange will start pulling equity from your other winning positions to keep the losing one alive.
Exactly. A liquidation in one position under cross margin can create a domino effect, putting your entire portfolio at risk. It requires much closer supervision.
We should also just mention that the exchanges have their own risk limits that sort of override everything.
They do. This is the exchange protecting itself. As your position size grows, say, from $50,000 to $5 million, the exchange automatically forces your maximum available leverage down. They demand a much higher margin for those huge positions.
They know that the bigger the truck, the more braking distance you need.
Precisely. Which brings us back to the ultimate non-negotiable risk control, actually using a stop loss.
The source is called trading without a stop, blow-up behavior.
And for good reason. A stop loss is your only automated guardrail. In a crazy market, prices can gap, jumping right past a point where you can manually exit. Without that automated stop, you are just one bad event away from a loss that could wipe out your entire account.
So we've covered the theory, the math, the mechanics. Moving from the fear of the multiplier to the reality of position sizing, what is the ultimate synthesis here?
The one-sentence takeaway is this. Effective trading isn't about the leverage you pick. It's about mathematically calculating your position size so that your stop-loss distance always equals your predetermined dollar risk. Control the size, not the sensitivity.
I love the analogy one of the sources used to make this stick. Think of leverage as the sensitivity of your car's steering wheel. At 100x, it's incredibly twitchy. A tiny movement, and you can veer way off course.
But position sizing, that's the size of the vehicle itself. If you're driving a massive semi-truck, a huge position, it has enormous momentum and risk. No matter how sensitive the steering is, once that truck starts to slide, it's so much harder to stop.
And it needs a much bigger safety margin than a tiny car. If you control the size of the vehicle, you control the momentum of the whisk. It's a complete mental shift.
It is. And here's a final thought for you to chew on as you start applying this. Exchanges might advertise 100x leverage, but think about how the required maintenance margin for larger position sizes changes your effective maximum leverage.
So the exchange's own rules are forcing you to use less practical leverage than what's on paper.
Exactly. The exchange's risk management, which demands a thick safety buffer for size, often forces you to allocate more capital than you'd think. In a way, the exchange is your involuntary co-pilot in risk management.